I'm Stephen Paice, co-manager of the Baillie Gifford European Growth Trust. As long-term investors, dealing with periods of underperformance is one of the toughest parts of the job. But for those who remain patient, it can be one of the most rewarding parts. Remember, the big money is not in the buying and selling, but in the waiting. Yes, we've had a few years where performance hasn't been where it should be, but we have been through cycles like this before. The positive is that we've learned from each experience and emerged in a much better place every time. Over the last financial year to the end of September 2024, we delivered just over 9% in share price terms, which lagged the 15% you would have got from the index. Looking forward though, we believe that there's a much more positive story emerging. Our publicly listed companies, now around 94% of assets, generated a return of around 20%, comfortably outperforming the index. These include companies like Spotify, which now has over 600 million users, Adyen, a Dutch payments platform, and Schibsted, a collection of Nordic online classifieds businesses. These, and many of our other companies, have spent years investing in growth and are now in the position to reap the rewards. 3 of our 5 private companies are also progressing very well, especially Bending Spoons, a rapidly growing and profitable Italian software company, which is now our largest private investment. Most of the underperformance last year is therefore explained by the write-down in the valuations of the other 2 private companies, Northvolt and McMackler, and the widening of the discount to the trust's net asset value, or NAV. Northvolt has been particularly frustrating. Despite its strategic importance for the European battery industry, a slow ramp-up in production and then a lack of funding has unfortunately led to a Chapter 11 reorganisation, or a form of bankruptcy protection. McMackler, a German real estate broker, has also faced some funding issues, although its balance sheet now looks much better. As it stands though, we've decided to write off both original investments. There is still the possibility of a positive outcome, however it's a much lower probability than we would like. I think there are lots of reasons to be optimistic. Our differentiated strategy of looking for European growth companies, both public and private, that can at least double in value over 5 years isn't broken. Interest rates are lower, inflation is being managed, corporate activity is picking up, and inventory levels across many industries are now much healthier. This environment is much more supportive for our style of investing and for the companies we invest in. We've improved the quality of the portfolio by adding in companies like Instalco, Dina Polska, and Novo Nordisk, and weeding out some lower conviction names like Caring Evotech and Delivery Hero. We have exposure to growth trends that should last for decades. For example, companies which grow via acquisition or serial acquirers, healthcare innovation, digitalisation, and increasing wealth, particularly in emerging markets. Most important of all, though, is that fundamentals are also very strong. Our companies are growing sales and earnings faster than the index. They're profitable, make higher returns on invested capital, and have less debt. The price we pay for this growth through valuation multiples has also come down significantly. As they should, however, our board, who remain very supportive, is holding us accountable by introducing a performance-related tender offer. This means that if the growth in our net asset per share doesn't outperform the index over the 4-year period to September 2028, shareholders will be given the option to sell all their shares at a price close to the trust's NAV. Looking at the fundamentals of the companies we invest in and current valuations, we really don't think this will be triggered. But if it is, then at least shareholders will benefit from the uplift in value from the closing of the discount, which is currently around 15%. So we have a performance hurdle to clear, a challenge which we gladly accept. Our patience will continue, as will our focus on what we believe to be the best underappreciated growth companies in Europe. And by doing that, we're confident that we'll get back to delivering the kind of returns our clients have enjoyed in the past.